Welcome back to Vantage. We've got an old friend of Edison's back on the show. He runs a small cap investment trust, very value orientated. He gives us his views on the economy, rising rates, with the Bank of England's going to get on top of things, and what he expects over the next 15 to 18 months. Fascinating to understand how he's picking winners. Let's go and take a look. Welcome back to Vantage. We are joined by an old friend today. Great to reconnect with Richard Staveley. Richard, before we get into the fund, maybe a short introduction to yourself and your background and what brought you into the fund management industry.
Thank you very much, Neil. Well, I sort of got interested in markets when I was actually at school, and it was that late 80s bull market, and I was sort of interested. Wall Street had come out, all that sort of thing. And at university, I did some work experience through a friend of the family in the city, and really enjoyed it. And they encouraged me to do accountancy, and as a way in to the city, which it still obviously is. And so I did my 3 years chartered accountancy and literally resigned 2 weeks after qualification to join a hedge fund with a guy called Mark Bradshaw, who'd worked at Mercury, one of the big houses of the 1990s. And it was just, I just absolutely loved it, and I knew it was for me. He had an all-share fund and a hedge fund, and the all-share fund did small caps, and that's where I sort of started seeing what could happen. And it was also the TMT bubble, which made me even more going, with this stock market is just quite a phenomenal thing to be involved with. And after Mark, I moved to SocGen Asset Management, where I worked with Nicola Horlick, or for Nicola Horlick.
Okay.
And it was there that I started working with Hugh Sargent, from who I started River Mercantile with, but Hugh put me in charge of the UK Smaller Companies Fund in 2001, and sort of never really looked back. It's just a great environment for investing. There's so much choice in UK small cap, and it's always been inefficient because the big money looks right up the market cap, but it's actually probably more inefficient than it's ever been. So I still have a great passion for investing, and it sort of stays with me. I think once you've got the bug, it's very difficult to lose it.
Yeah, no, it's a fascinating space. And I think, you know, when we get people on, we love to learn a little bit more about the personality of the manager, and I often look for sort of moments in the career, and I think you've been through that over the last sort of 18 months, that transition where from Gresham to Rockwood, and I don't want to get into the detail around that, but what I want to understand is, you know, what you learned, what you felt, and, you know, what you took from that change.
Yeah. Okay. So I mean, it was over 2 years ago now. It feels quite a long time ago. It was an interesting period. I think what I learnt most was in those sort of, I don't know, David and Goliath type situations. You need to have friends around you, really supportive network of friends, strong, both professional and private, and family. And I think I really realised who they were during that period, and that was critical to me, having the strength of character to sort of push through. I would also say, you know, I couldn't believe at the end of that outcome, I'm sort of ringing the bell on the London Stock Exchange as we take Rockwood from the AIM market to the main market, and wonderfully, you know, got Fund Manager of the Year in the PLC Awards, and you sort of reflect on that and go, well, actually luck is actually something that features in all our lives, and we're not very good at attributing things to luck. It's much more easier to attribute to our own brilliance, wonderful or hard efforts, but luck both in life and in investing always plays a role, and I think I have been lucky in life as well. So
yeah, well, it's a good segue, because I've always enjoyed. I remember talking to you during the COVID period when we were in lockdown, and you were talking to me about how we were permanently reducing capacity effectively the longer this and it was I thought it was very insightful, your views. I've always enjoyed hearing your sort of macro views, I know you're a Ray Dalio fan.
Yes,
So,
yeah,
and
yeah.
Ray Dalio does say something about sort of crystal balls. But tell us, with that caveat, you know, what your current view is in light of you know what we're seeing in the UK, this sort of persistent inflation, rates rising, and real question marks about whether the Bank of England is going to be able to control it.
Yes, I'd agree that forecasting generally is folly.
Yeah.
So hugely caveated. I think that we're in a very early stages of what is clearly a massive regime change. If we go back, you know, interest rates actually, when I won my first fund in 2001, were 5%.
Yeah.
What they are now. They were 5% when I started River and Mercantile. When I was doing my accountancy, I checked the other day, they got up to 7.5%.
Yeah.
But since the financial crisis in late 2008, they've been zipped. They've been absolutely nothing. And that has been the backdrop to how markets have behaved, how lots of younger investors have experienced their careers. And that has all changed now. We've got interest rates at 5, and then there's a spread on top of that. I'm afraid the outlook isn't good. Simply speaking, they need to get inflation under control, and that is going to be painful. Jeremy Powell has said there's going to be pain. There hasn't really been very much pain yet, and it's because the transmission mechanism of interest rates takes time to feed through. These 5% rates are only going to really impact in 6 to 9. We haven't really yet quite seen the impact of the moving up through threes and fours, but we will. And the thing is that no one's really making this argument, I don't think, to the general public, but basically inflation affects everybody. It affects literally everyone in society one way or another, pretty much negatively. But sadly, unemployment affects a smaller proportion, a much smaller proportion than but society's got to, the greater evil is inflation for everyone than unemployment. So I'm afraid we're going to have to accept unemployment going up, going into a recession, and as a result, taking that tension out of the labour market. I mean, you know, Captain Pete Mitchell would say that, you know, the inverted yield curve is the best lead indicator of recession. It's inverted. It's likely we do have recession. And that is going to be a difficult period for investors, for companies, and for individuals. But once it grinds down in inflation expectations, which haven't been there, they've been for a decade. You ask someone, what about inflation? The man on the street, woman on the street will say, you know, 1 or 2%.
Yeah.
Now you ask anyone at dinner with mates or in the pub, what are wages going up by? And they'll go, oh, 5, 3, 6. They never say 2, which is what the Bank of England needs to get us down to. So we need to get that broken in order to get inflation under control. Then interest rates should be able to moderate, and we can push through. Okay.
So with that background in mind, I mean, you know, there is going to be a sort of tough period, whatever that is, 2 years. Let's hear a little bit about the fund that you're managing now. So tell us a little bit about Rockwood Strategic, objectives, structure, AUM. Walk us through it.
Okay, so Rockwood Strategic is a closed-end investment company. It's an investment trust. We've got about 54 million under management now. Our objective is to generate returns from our investments that can do 15% a year IRRs. And how we get to that is that I basically look for stocks that can at least double in value over 3 to 5 years. And the way the maths works, you know as well as an analyst, you know, if it doubles over 5 years, you get 15% a year. If it does it over 3 years, you get 25% a year. So we look for those, not 3 baggers, 4 baggers. Sometimes they end up being that, but the premise is that it needs to be able to double over a reasonable time frame. We seek to do that in a concentrated manner, which allows us to do significantly more due diligence than most fund managers would do. And we structure the fund in such that we have 5 to 8 core investments where we seek to have at least 5% of the equity and ideally 5% weighting in the fund each. The top 10 are the majority of the capital of the fund. And then we have a second category of smaller weightings, which typically between 2 to 4, which split into two types of investments, what we call springboards or opportunities. And the springboards are ones that could become core investments later on. Maybe the opportunity to take a big stake hasn't quite occurred yet, or we're waiting for it to de-risk a bit before we really go into a significant position. Or straight opportunity situations, which meet the characteristics which we look for in shares, which is essentially recovery situations.
Yeah.
But those opportunity ones are ones where we won't roll up our sleeves. We can see everything's in place already. Maybe someone else is driving it, but we like the valuation. We like the opportunity for a turnaround. They're typically the more liquid ones, and so we can sweat the capital for investors. So we have this currently we've got 19 holdings, and we're seeking to compound wealth. We're super aligned. It's really important. So Christopher Mills and myself have just under 29% of Rockwood in personally invested. And actually, I think by the time this interview's released, I would have purchased some more. I'm actually buying stock in Rockwood right literally as we speak.
Yeah.
We're very aligned like that. We also have a performance fee, which we charge over a hurdle of 6%, and it's a 10% fee. So that gets us very aligned. And just finally, it's the only thing I do.
Yeah.
It's the only thing I'm focused on. It's the only fund, and hopefully we can just compound wealth and make everyone some money over the next few years.
And the benefits, rather than, because I think quite a lot of your peer group run open-ended funds, whereas you see benefits in the closed-end structure.
Absolutely, it's critical. I think actually if it wasn't the way that the fund management industry makes its money, we should have more money in closed-end small-cap funds than we do. Most of small-cap money is in open-ended investment companies, where you can withdraw your money from the fund manager in whether you're panicking in a Neil Woodford situation or whether you've just your view changes on the world, you can whip your money out. And because the regulation in the industry and the size of these funds, it's meant that they have to manage their liquidity in a way that most of the fund managers wouldn't really naturally manage their liquidity. They would go, I don't mind being illiquid, I'm going to own this for 5 years, why do I care, that I can't sell all my position in 2 weeks, So the open-ended funds do have an issue, and with closed-end capital, which my hero would be unsurprising for it to be, but Warren Buffett, I think often people forget, Berkshire Hathaway is an investment trust. He's basically, there's a lot of huge wisdom. He's an amazing fund manager, but one of the key criteria, I think, is he's never had to be able to have his money taken away. So he can do things that he sees and really have the time for that thesis to come through. And that's been really eye-opening since I've run this strategy.
Okay. So I want to get into this 15% IRR, the doubling of your money over 5 years. In the context of you've been doing this for a long time, we think the market structure has changed. There was a conference, a hedge fund conference 2 or 3 weeks ago, actually in the US, where David Einhorn spoke about his special sits strategy of finding something on 12 times PE where he thought earnings were underestimated, holding that out over 2 or 3 years, etc., seeing those earnings re-rate and then the valuation re-rate, and then suddenly you get that sort of, double impact of earnings going up plus being multiplied by a high multiple is getting harder and harder to do. And part of the reason is that the mutual funds that used to soak up the stock just don't participate in the lower end of the markets. Everyone's moved. There's much more sort of flow in the larger stocks. I'd be curious as to whether also, if that's the market that you're operating in, how do you sort of cater for that? How do you make sure that you get to the right companies and that you're not in effectively a value trap?
Yeah. Well, I think the way I've approached that is to be really intellectually honest with what's happening in the market.
Yeah.
And it is the fact that there's been structural change. So buying a stock and relying on another fund manager to buy it off you when it's doubled used to be pretty much what everyone thought. In fact, most people would just go, I don't even think about the exit thesis. There will always be liquidity, and I'll just quietly sell it on into momentum in a couple of years' time at a higher price. You can't rely on that now. So you have to rely on capitalism, which I still believe strongly in, and that if you've got good businesses which are undervalued, generating strong free cash flows, and have sustainable business models or protected niches, then people will come. They will come in the end. And the people are coming. It's basically private equity are all over this space. And trade buyers, both overseas people looking at everyone's given up on the UK. Oh, it still happens to be in G7, by the way, with the rule of law and all the rest of it. What's everyone given up on in the UK? Private equity, when I started, was it was a very small industry. I mean, I did read one of the great books, The Barbarians at the Gate, about KKR and Nabisco, the Nabisco deal. It was in the US, but it was very little, 25 years ago. It's a huge market now. They are crawling all over UK small cap. So the key is to understand what that means, and that means I have to buy stocks that I absolutely think could get taken over in 3 to 5 years' time. Essentially, and that means what are the types of companies that private equity are attracted to? What companies might have obvious consolidation candidates within their end industries, and then actually accept that 80% of my realizations are going to be non-market participants. I still think there's a role. There'll be 20% of the market, I reckon, will at least be other fund managers buying it off you that have bigger funds or interested in bigger companies, or companies, or once they've turned themselves around, are much more stable, and that will still exist. I think Einhorn, the great Einhorn, is there is an element of the market regime change and cycle, which might mean some people are sort of sitting on their hands a bit. They can see the value, but you might have to slightly wait a bit longer. And I think one should accept that it might take a little longer than before.
And interestingly, David Einhorn's conclusion was the same, which is he's relying on trade buyers and private equity.
Right, was it? Okay,
so
great.
That's his strategy is to, I think the way he articulated it is, I'm entering into the sub $5 billion wasteland. Because even if I buy something on 5 times, if someone takes it out at 6 times, I'm making 40%, right? So, etc.
So I think the thing, just responding to that, I think that is essentially little old Rockwood is doing what David's doing, but on a very small scale, in a much smaller market. But there aren't. What is the case is that with what Einhorn's doing, even in America, is there are very few funds really doing this in the sub 250 million market cap. The bigger you look at UK small cap funds, and you look at what the main franchises own and what they're in their top 10 holdings. They are miles bigger than the things that we're looking at. Like factors of 5 and 10 bigger.
I get that, and big fund management houses just don't commercially. There's a limited amount they can do with it. You can't scale it, so I completely understand that. When I read your fund literature, and particularly in light of the environment we're in, rising rates, tough environment, you've got a strong value bias right now. I'm not saying that persists forever, but right now, the way you're protecting yourself is focusing on value. How do you assess value? So it's easy to say I take I value something. How do you assess value?
How do you assess value? Okay. Well, maybe as just a preamble from that, because I've always had a value bias, and there have been periods in my career, particularly when later stages when I was running the small companies fund at Majetti Asset Management, where that value bias was actually quite difficult headwind for my approach going forward. I put it down to the fact that interest rates were being manipulated and that would change. It took slightly longer than I thought for that to change, but that has happened now. So I do feel that value is going to, at least as a factor, be at least as efficacious as it was prior to interest rates being manipulated. So the long-term value factors, by the cheapest stocks in the market, always outperform the rest of the market over any medium-term time horizon. So I am going to stick to that going forward. Quite a few, as you probably know, quite a few of the other value managers had to sort of who's like end of career stuff in this cycle. So I'm thankful I've managed to get through to be able to keep prosecuting a value approach going forward. But what is value, as you asked? So it's around free cash flow to equity. It's about a perception of owning, as if you owned the whole business. Buffett says exactly the same thing. It's like buy a share, but it's like I own the whole thing. And if I own the whole thing, how much free cash flow comes back to me to pay for what I've paid for that business, and without it needing to all go back into the business, or it not generating sufficient cash flow to come back to me having bought the business. So free cash flow yield, projected free cash flow yields are the key. I think DCFs are highly dangerous. I don't do them. I had to do them all, learning them for the CFA, my CFA qualification, or ACAs, but I think they're super dangerous. So it's really a 3 to 5 year view on free cash flows on a spot basis. Now, a couple of other things to do. We do look at, I'm quite absolute based, so we don't have a benchmark now. So it is definitively looking at, no, that's cheaper than that. That's not good enough. It's got to have absolute value. And also, I've always measured value alongside these other measures in terms of EV to sales relative to operating margin. If you look closely across any sectors over the medium term, most stocks will correlate their EV to sales ratio to their operating margin, i.e. if you're on 20% operating margin business on normally, you migrate to about a 2 times EV to sales ratio. But in recovery situations, you often get businesses that are on less than 1 times, but when they're sorted, they should be making 15% or the other way around, and that's one. But when you've got very limited profits, some of the spot multiples aren't very helpful for knowing where the value is. We also do look quite closely at what market participants are paying when they're having to buy whole businesses. So transaction histories, small, medium and large in private equity as well, that does inform us where value might exist. It is definitely an art, not a science, but those are the key criteria. I think one thing that was, I'd also just, that I have found amusing over the years, I was scratching my head quite significantly in the last few years as lots of people got obsessed with buying stocks on ARRs, annual recurring revenue. Oh, this is a 4 times IRR business, and it hankered back to the TMT bubble when I started, when there are all kinds of other ridiculous measures that people use. But what was happening there, the ARR measure does have a kind of intellectual thinking behind it. But what people were forgetting is what they were focusing in on ARR businesses was essentially bonds. ARR businesses are bond-like, and bonds have been part of this manipulation, and those kind of multiples that those businesses confront, particularly relative to their free cash flows, are having a grand awakening now, and I don't think they're going to come back for some time for the market as a whole. There'll always be people that play in that field. But,
So that it's a good segue, because you talk about the fact that you look at transaction multiples, and where you are right now has the benefit of a network. So talk to us a little bit about what Harwood brings to you, how you leverage that network, and unusually I think you have an investment committee. Not every manager does, so you've got a team of wise people kicking your core investments.
Well, we'll come back. Can we come back to that? I'll do the first bit first, and then I'll come back to that, because we've evolved that situation, and I'll talk about it in a bit more. But in terms of Harwood, Rockwood couldn't have ended up in a better place. Christopher Mills, the founder of Harwood, obviously over 40 years of investing, both in private equity and public markets, and phenomenal network. I've managed to build one up over the last 25 years, but his is outstanding. And as a result, in Harwood, it only has closed-end investment companies, and it has a strong bias to small companies. The Harwood also owns 50% of Edison, and so we have these fantastic fund managers like Christopher, like Stuart Widdowson, who have their networks and insights, and are meeting companies all the time in a very informal and fluid kind of environment at Stratton Street, where we all sit. Christopher's on his 6th private equity fund. The returns are fantastic. Over the years, all funds have done very well, and it actually plays in a kind of size of company that's not that dissimilar from roughly where we're all focusing in public markets. But the portfolios they have in the various maturing funds means that we have a kind of direct insight into all the operational developments, what's happening in these businesses, what they're seeing, a kind of real time, rather than waiting for results that you do in public markets. We have a sense of what's happening with employment, with confidence, with actual order books, and also how they're seeing credit markets as well, and understanding those in our context. So it's really that environment. I think I would go as far as to say it's the best ecosystem I've worked in so far for network.
Okay. And the
investment committee, yes.
So.
Well, yes. So Barton Biggs, the other fantastic hedge fund manager, once said that if you scour the world's great cities, parks, for statues, you'll never find one of a committee.
Yeah.
So I'm actually not a believer in committees. There was one at Gresham House.
Yeah.
I think it's for public equity investing. It's not the optimal way of doing things, i.e. having a group of people basically gating yes or no on the fund manager who's worked with other people, done a lot of work with the team, whatever. Now, the insights and you get from a group-wide approach are definitely significant. Mm-hmm. The issue is about, does that group then get the best outcome of decision making by having to say yes or no?
Yeah.
And it also can, just by reality, it can inject, should we say, a loss of fleet of foot into this process, when sometimes opportunities can happen relatively quickly, and if you've got to produce a 50-page report just to get started, it can be a problem. That said, so at Harwood, what we put together is an investment advisory group. So that's the IAG, that's what we call it.
Okay.
And it's got 6 guys. It's where Christopher sits in relation to Rockwood. It has this sounds like a bit of it is a marketing strap line, but the 6 individuals have 200 years investing experience between them when you add it all up. There's quite a bias in the Rockwood Investment Advisory Group to practical fund managers who have invested in public markets significantly during their careers. People like Adam Parker, who was one of the founders of Majetti Asset Management. Rupert Dyson, who the founder of Edale and was at Sloane Robinson. And what these guys do, it's great. It's so when I want to go core, when I want to go to a more significant position, I will probably produce a research, a few typos, not completely finished article.
Yeah.
It gets sent to them, and then we discuss and I get insight into their views. Now that comes in a variety of forms. It might be Christopher going, oh, I know Bernard on the board, I've known him for 20 years, do you want an intro? And then great, so I can have a kind of friendly intro to a board member to get their perspective rather than just executive management, which is what a fund manager might only meet as part of their investment process. It might be Adam going, oh, I come across that finance director, no wonder it's in trouble, this company, you need to get rid of him straight away, he's absolutely useless. It might be Yuri Kojamirian, who's brilliant analyst and fund manager, who might go, look, I'm not, are you aware what's happening structurally in that industry? That's why there's the structural change. We've got to be careful there's not a value trap. A specific example was actually in a more recent one, which I may talk about a bit later, but where Jamie Brooke, who's been investing for over 30 years in UK small cap strategically, the company has a pension fund problem. Has a large pension fund, and we need to get that sorted as part of unlocking all the value. And he was able to set up meetings for us with the top buyout team in the UK, ex-Goldman Sachs, Paternoster. We then had meetings with them. They then were able to then, they could see what to do. We've then introduced them to the company. The company are now talking to them, and we're kind of engaged in helping it come out. And that's all come through. I'd have never have managed to do that through if it hadn't been for the advisory group. What they do is I would back myself after this long not to come with ludicrous investment ideas to these guys. So it's nuanced about risks. It's about maybe the upside's not quite as much for these reasons. Maybe this is how you unlock the change. It's that, and that's how they help. And it's great.
Fascinating, and I completely get that. I mean, I people like Pete Davies talk about the fact that they need people to talk, have an honest conversation about things that they're investing in, etc. So I get the benefit of that. We touched on private equity coming and creating exits in the market. You've had a few, and I mean, I was looking. I think it was the last fact sheet. Your cash position's reasonably high as a result of that you've had a number of takeouts. I guess what I'm trying to understand is, what's in your mind in terms of the velocity of which you want to deploy that. Are you going to be cautious in light of the macro environment, or is it going to be, look, we see great value right now?
Yeah, so we do see great value right now, both the UK market, small cap, and value stocks within small cap. The cash position after the great Crestchick takeover, which occurred sort of early March, and another takeover we had, got the cash up to about 33% of the portfolio. But as of today, it's actually at 14%.
Okay.
So we have actually been relatively... well, it's been measured, it's happened over 3 months, but we've been able to deploy that into some new positions and add to a couple of our other existing positions relatively quickly, quicker than I actually thought. But part of that was because we kind of knew the Crestchick deal was happening for some time. So we were very minds on about where we deploy it. And also in that process of running up, I'd actually run cash down to very, very low levels. So I'd had sort of pent up things I wanted to do. So we had a kind of like ready-made pipeline to invest. At sort of 14% with the velocity on the rest, I'm actually pretty cautious. This isn't a sort of ode to Warren Buffett, but one of my favourite quotes about Warren Buffett is waiting for the fat pitch, the baseball term, and about why I'm waiting for something that's really, really attractive rather than things that look just attractive. Just keep waiting for the one that's easy. And it was about baseball players whose batting averages were best, who swung the bat the least. And we're obviously in Britain, we'll probably call it, and with the Ashes coming up, it's a sort of the slow ball just off the off stump, waiting for that to hit a sort of Bazball style six. But I think, so we're cautious. We could, of that 13, if the really excellent opportunity came along, we could deploy half of that, like literally in one investment. So, but we have got a couple of live things that are smaller that we're likely to invest. So I wouldn't be surprised if cash is down to sort of X out into other new takeouts. And one of our companies is in takeover talks. That's been announced. Down to about 5% by year end wouldn't surprise me.
Okay, that's good. So you'll look for the right kind of opportunities, but not in a rush to deploy. That is the takeaway. So it's been great. I think you've given us a really good perspective on your views, where you're looking to invest, how you go about doing it, the benefits of where you are right now, and how that comes through. At the very start of this sort of conversation, I'm like you. So I think 2 weeks after I qualified from Pricewaterhouse, I left.
Me too. I was PwC too.
I left. I think the difference between you and me is that I chose not to take another exam again in my life. So I think with that sort of, I'm not a glutton for punishment. I'm wondering what you're going to do over the summer to unwind and relax.
Well, Neil, I literally just reading annual reports.
Really?
No. Do enough of that already. No, I think actually, but reading actually. I buy more books than I can actually read.
Yeah.
So my wife gets pretty irate because they build up these stacks of, and I go, oh, that's going to be really interesting. I really want to read that. I want to read that. What wider reading, and I've got a huge pile that I want to get through, and I typically catch up nearly over the summer.
I think it's a great period. You know, I think the importance of the summer for the city is we all go away and get inspiration or reinvigorate our thoughts and get new ideas. Fraser used to do a famous book review at our summer party. So September, he used to stand up and recount what he read on the beach that year. Richard, it's been a pleasure having you on Vantage. For the viewers, if there's any other managers you'd like to see, please let me know. But thank you very much for joining us for another Vantage series. Thank you.
Thank you, Neil, very much.
Pleasure.